if you go back to every downturn, the COVID drop, the 2009 collapse, all these things, the market is conditioned to say, okay, Fed, bail us out. Well, we're going to get into a recession, and then the Fed is going to say, hey guys, we're not printing money. We can't with 4% inflation or 5% inflation. And that's going to be a huge wake-up call to the equity markets. And you're going to see a prolonged bear market. And this is getting into that longer-term projection. I don't think we're going to make new all-time highs for at least a decade.
Hi, I'm Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for October 25th through November 1st, 2022, while supplies last. This week, we feature two silver specials. First, we have 90% silver at $11.49 over spot. Prized for its recognizability, liquidity, and easy divisibility, constitutional or junk silver is also in short supply. As Andy Schechtman says, they're not making any more of it. Our 90% silver is mixed, meaning it may come as dimes, quarters, or both, but it has the same silver content either way and is available at $11.49 over spot while this batch lasts. Our second silver special is 100-ounce PAMP Swiss silver bars. Known for their quality and artistry, PAMP makes these IRA-eligible bars 3 nines fine and with their own individual serial numbers. They come 5 to a box and are available at only $4.59 over spot. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Gareth Soloway from InTheMoneyStocks.com and VerifiedInvestingCrypto.com. Gareth, thank you so much for joining us today.
Oh, you're welcome, and thank you for having me. It's been I've been looking forward to us chatting.
Definitely, and I would like to discuss what's happening in the stock market recently. We're seeing, it seems like, quite a bit of a rally. However, we haven't made it above the last high we saw when we saw that bounce in July and mid-August. Your perspective on where we are right now, and do you still think we're in a bear market?
Yeah, I definitely still think we're in a bear market. I mean, the longer-term trend on the S&P 500 is still fully intact. Like you mentioned, the July-August high, we still haven't even come up to close to testing that. In fact, let me show my screen here so we can kind of take a look at the chart itself. So this is the SPY, which is basically the S&P 500. And what you can see is the long-term downtrend from the high on the spiders is still fully intact, and we still have a decent distance to go. So for me, as long as we're below that line, the downtrend or the bear market is fully intact. Now, one of the interesting things you can see here is that if you take the 2020 low and connect it to this pivot low, look at how we broke that line, but now we're coming back and kind of testing that area with resistance. So it's a great day on the markets. I think today it's a sigh of relief for the markets. And what I mean by that is, we saw Meta's earnings, we saw Google, we saw Microsoft. I mean, it was just bloodbaths everywhere. Then yesterday after the bell, we got Amazon, and that was a catastrophe. And then Apple reported, and it was going down, and then it reversed, and now it's having a big up day. And everyone's like, oh, thank goodness, like we just avoided a major accident or collapse in the stock market. And so now you have a scenario where the big earnings of the trillion-dollar companies are over. The market now is going to focus back on the Federal Reserve. And I think there's this air in the market where the earnings have been so poor that the market is really hoping that this is where the Fed will say, okay, we're still hiking 50 or 75 at this November meeting, but afterwards we're going to take a pause. We see the economic data. We see that the earnings are getting really hammered here. So let's wait for a few months. And the market is craving that pause so badly.
It seems kind of odd that the Fed would even start to pause because we're still seeing inflation quite high, above 8%. So if we do hear about some sort of pause at this next Fed meeting coming up, or talk about a pause, right, because it looks like they're going to be raising rates again, what will be the justification for that?
So I think the justification is multifold. So number one, I do think that a lot of the economic data is lagging a little bit, like the jobs numbers. We know jobs numbers lag. They've been strong, but I do think you'll see this kind of cliff dive in jobs numbers coming out here soon, maybe as early as next Friday. I do think that if you look at the PPI data, it's starting to show that we're seeing a reduction in inflation. And remember, the producer price index leads the CPI. So producers kind of see the inflation coming down, and then eventually they pass it on to the consumer. So there's kind of this 1-2 punch there. And then I think that the Fed, you have to look at what we saw with the Wall Street Journal article a couple Fridays ago, where they kind of said, hey, the Fed's going to raise and then pause as well. And the Fed has used the Wall Street Journal as their conduit to try to kind of give the markets a heads up. And so I think that was important. And I think more than anything, you have these central banks like the ECB, the Bank of England, the Bank of Japan. Their economies and their currencies are almost at breaking points because the dollar has gotten so strong so quickly. So it's not so much that the Fed, I think in a perfect world, the Fed would want to continue to raise, but they have to be careful here because they could literally cause a systematic breakdown in the global system if the dollar continues to get too strong.
Now, what kind of breakdown are you looking for, and how could that impact the markets?
Yeah, so I mean, when we talk about a breakdown like this, we're talking about things like, Credit Suisse. We saw that collapse. I mean, do they just have a bunch of derivatives that just start to go bottom up or turn over and go bankrupt or go to zero? I mean, you look at certain breakages because there's just so much pressure on these other systems, and everything's been built on this house of cards of cheap money or free money. And so when you raise interest rates as fast as the Fed has done, it's inevitable that there are certain assets out there that can't handle that. Investors are pulling back from the bond market or from bonds. Bond prices we've seen bonds declining because interest rates are going up. The stock market was cratering until recently as well. And you look at other things like what the pound was doing against the dollar, what the yen had been. The dollar yen was just surging as the yen was declining. And so there are breakages that will occur because it happens too fast. And I think what investors don't understand is that if you go back to Volcker raised interest rates. I think he raised from like 12% to 17% in a very short amount of time. That was a 50% hike in interest rates. But if you go to what the Fed did, the Fed raised from a Fed funds rate of 25%, 0.25%, so 25 basis points, to now 3.25%, potentially 4% after next meeting. How many hundreds of percentage points is that to hike things, right? You're talking about hundreds of percent. And that is meteorically more detrimental to the system than what Volcker did, even though Volcker raised a total of 6%.
I think those are very good points there. And as we see then the impact on the markets here, what is your long-term outlook? We're looking at the S&P 500, the ETF there. But what is your long-term outlook? And for people who bought near the top there, how long do you think it'll take until we get back to those levels?
Yeah, so I do think there might be a little bit more near-term upside in the S&P 500. It wouldn't be shocking to maybe head up to 390 on the spiders. That would be around 3,900 on the S&P. I even think 4,000 we could test. But I do think that at some point, and this is going to be what the market's not prepared for, and this is where I see the next big leg lower, and then I'll get to like my really long-term projections. But basically what I see happening is the economy is going to fall off a cliff. And the reason why I say it's going to fall off a cliff is because you've had consumers that have been very resilient. They saved money during COVID. They've paid down credit card debt during COVID. And now they're basically spending that money because, number one, inflation's high, so they have to kind of spend some of it. And partially they want to travel. No one likes being locked down and kind of hunkered down in their home. So they're traveling, they're doing this, they're doing that. But eventually that money runs out. Eventually those credit card limits are hit again like they were prior to COVID. And all of a sudden the consumer is going to be like, whoa, I gotta pull back on my spending, right? And in addition, look at all these publicly traded companies. They're either saying we're going to slow hiring dramatically, or many have said we're cutting 10% of our workforce or 20% of our workforce. And so there's a storm brewing here where, again, the Fed has been going gangbusters on hiking because the data has been strong. But I worry that at some point we fall off that cliff. And the detrimental part to the stock market is going to come when you basically have the economy fall off a cliff, inflation is still pegged. Let's say it comes down from 8% to 4%. But even when we're in a recession, how does the Fed print trillions of dollars with 4% inflation? I just don't see how they can. But the market is conditioned to assume that they will, right? So if you go back to every downturn, the COVID drop, the 2009 collapse, all these things, the market is conditioned to say, okay, Fed, bail us out. Well, we're going to get into a recession, and then the Fed is going to say, hey, guys, we're not printing money. We can't with 4% inflation or 5% inflation. And that's going to be a huge wake-up call to the equity markets. And you're going to see a prolonged bear market. And this is getting into that longer-term projection. I don't think we're going to make new all-time highs for at least a decade.
Now, it seems like then for investors who are looking for somewhere to invest in, what are some of the value plays you're looking for right now?
Yeah, absolutely. So before we get to value plays, I want to show you a chart, and this is kind of very similar. In fact, before we do that, let's just look at the S&P 500. So number one, look at this monumental run since 2009 when the Fed was printing money. Look at the vertical nature of the market, right? Just unbelievable. Like even if you go back to the .com period here, it still was nothing like we experienced in the last really 13 years. Now, if you want to look at a chart that's very similar in start and see what happened, take a look at the EWZ, which is the Brazilian stock market. So in 2002, the Brazilian stock market had a very similar vertical move to 2008. And then look at what's happened. We have never gone back even close to those all-time highs, and it's been 14 years. And so I do worry that this is the market of the future for the S&P 500, where we do have mini bull markets in the mix, but ultimately it's going to be a long period of digestion of this. As long as the Fed's not printing, the market has to come to grips that it has to figure things out on its own. And like a kid that gets spoiled, I have a hard time believing that the economy is going to be able to figure it out. Now, having said that, like you said, where am I putting money to work? So I'm a big believer there's always places to make money. So, I mean, number one, I think gold is the place to go right now. Gold's had this beautiful pullback. It's kind of trading down today pretty decently. But if you look at the larger picture, gold is doing exactly what it did during the 70s before a run from about $100 an ounce to $1,000 an ounce. Now, I don't think you're going to see a 10x on gold, but I think a 5x or a 3x is very, very possible. So I think gold is a place to go where you'll see amazing returns in this kind of otherwise negative investor market. And then I also think like the EWZ, like we just talked about, you know, if you look at this, now it hasn't broken out yet, but if you look at this, it is kind of coiling, right? This is what I would refer to as a spring that's coiling. And if it can break above this $36, $37 level, that would be a huge opportunity with a lot of upside. So that's a place. And then if you look at other value plays, like I love stocks that everyone hates. And there's no better stock that everyone hates right there than Meta. So Meta, again, everyone's saying, oh, Zuckerberg, he's crazy. He's spending way too much on the metaverse. What if he actually has a plan here and the metaverse becomes something major and basically Facebook has built it or Meta has built it? This, at these valuation levels, offers, to me at least, a low-risk, high-reward opportunity, even in a longer-term bear market. So there's always places to go, right? I think that's the beauty of it, is that, you know, you can always find opportunities, and I think this is a good example of it.
And getting back to precious metals here, if you could share with our viewers kind of your outlook for that. I know you're very bullish on gold right now, but if you could expand on kind of the price action that we've been seeing right now and your view of it going ahead.
Yeah, sure. So number one, you have to understand with gold is that it's traded in US dollars. So as the dollar has rallied, gold automatically will come down, right? So the key to kind of gauge the analysis on gold and how is gold performing is to say, okay, how much has the dollar rallied in 2022? And the answer is about 20%. Well, how much is gold down in 2022? About 7%. So in a perfect world, gold should be down equal to what the dollar is up. So the fact that it's only down 7% is actually showing you accumulation. So that's a very big positive for me on the longer term here on gold. It tells me smart money is buying in. And then also, if you look at this chart, you had this nice little double top up here, but really what you're doing is you're consolidating inside of this bigger move. So I do think in a worst case scenario, you come down to about $1,550. But again, for me, As soon as you see the Fed saying we're going to have elevated inflation for a longer period of time, but we can't print and the economy is going to go south and all this other stuff, I think that's where gold actually starts to really outperform. If you look at the late 70s into the 80s, it was towards the end of the period where gold really took off. So I think you're in that kind of scenario.
So you're saying worst case scenario of that like 1500 level. What specifically on the chart gives you that number? Because I know I've heard numbers like 1350. So what specifically gives you that 1550 level?
Yeah, and I see that 1350. Like that's basically taking these pivots here, right here with these pivots. But I'm looking at this level here, and then also if you're looking at it in terms of a retrace, this would be about a 618 Fibonacci retrace from down here to these highs. So that's kind of a standard pullback. And it's just hard for me to imagine that if you look at the Fed going to, so number one, we're getting very close to a pivot where at least they're not hiking anymore. Maybe they're at 0 hikes, but not lowering. But that alone should cap the dollar from going up dramatically. And as soon as you see a pullback in the dollar, that'll also cushion gold and start to lift gold up. So for me, 1550 is my low end. With the fibs and different retraces. But again, we all know I could be wrong, but that again is basically to suffice it to say that on the way down here, I'm a buyer. I'm continuing to accumulate gold on the long side.
And again, I guess that points out not much downside potential, it seems like, for gold right now, but a lot of upside potential there. What about for silver? Your view on that?
Before I touch on silver, I think you're 100% right, is you have to look at it in terms of assets and risks, right? So I do see the stock market, the S&P has down another 25% in 2023. I still think Bitcoin hasn't bottomed yet. I think 13,000, maybe sub 10,000 before that bottoms out fully. So if you look at where to put money, where your risk reward makes sense and where you're somewhat protected, gold definitely does kind of pique my interest, and it has got me involved here. Now, if we look at silver, let's take a look at silver. So silver continues to kind of chop sideways here. You have this little bit of a wedge pattern formation. You can see you can connect the lows, connect the highs. It's having a little bit of a down day today. I continue to be a very long-term bull on silver, but I do think we have to recognize that if the economy is going to slip into a bad recession, that demand for electric cars may drop a little bit in the near term. Other things like that may hamper silver. So silver, there's a ton of support here, but there's also a longer term trend line where if we did see that worse kind of recession, then you're looking at potentially heading down towards this longer term trend line here, which is around $15.50, we'll call it. So there is a little bit more risk in silver. The positive is longer term. I still think it eventually breaks out of this longer term wedge and it will outperform gold. We know that historically it tends to outperform gold percentage wise. It's just a little bit more risk in the near term here.
And how do you balance those two different competing forces? It seems like you have the industrial demand for silver, which would slow if the economy takes a dip, but you also have inflation and the move in gold if we're going to continue to see inflation in a bad economy. So your perspective on that?
Yeah, so I think we're in this period, this next, let's say couple month period where we could still see gold come down maybe to 1550. Maybe some people have said 1350 or so. So I think if silver's going to dump out, it would be during that period. I think once you see gold starting to have that bull run, silver will also start it as well. So I think the risk in silver is in the near term here over the next, let's say 3 to 6 months, as it is in gold, versus if you go a year out, that's where both I see starting to rally substantially.
And if we also look at cryptocurrencies, I know you made that famous call of 20,000 on Bitcoin, which was a very dramatic move down. But now you are actually looking for lower prices in the long term. If you could expand on that.
Yeah, absolutely. So my real long term, 3 to 5 years out, I think Bitcoin goes way higher. I think eventually you see this pivot where we get good regulation, or at least regulation, so investors know the rules, right? And that's a big thing to understand for a lot of newer investors in crypto, is that investors, and you'll see this in the stock market, we hate uncertainty. We want to know the rules that we're playing by, and that allows us to make decisions about risk and reward. And so without this regulation, it's really keeping a lot of big money on the sidelines, which makes Bitcoin very very midterm uninvestable. Now, shorter term, you're going to get little pops if the dollar drops. If we have equities rally, you see the risk on trade come in. But we can very clearly see that the pattern here is this is a channel, and it is a bearish channel. You can't deny that. It is a bearish channel of consolidation. So this tells me we probably haven't seen the lows. Just the mere fact that I see the stock market having another leg lower, a substantial leg lower, that also indicates that as a risk asset right now, Bitcoin probably goes lower as well. And so again, 12 to 13,000 is where I'm looking for, probably within the next 6 to 12 months. And then I do think you finally bottom out. Maybe we pierce 10K. It's hard to know where these things bottom out. But I think once you get in the mid-teens, low teens, for me, it's just starting to slowly dollar cost average in, and knowing that my long-term views are so bullish on Bitcoin.
Definitely. So you're talking about really looking at dollar cost averaging in as we see Bitcoin fall. Can you expand on that?
Yeah. So again, even though I have a 12, 13,000 price target, my worst case scenario is 3,500. I think, again, you'd stop out a lot of people at a break of 10,000. So when you're trading, psychology is a big part of it. So the question is, where do you get max bearishness and people, like the most people, to throw in the towel and give up on it? That's usually the bottom. So the question is, where is that going to be? It's making me think it's more 10,000 or sub 10,000. But basically, the key here is thinking about it like, do you really know? And if your long term is so much upside of 100,000 or 2 or 5 or $1 million, once you get below 20,000, it's really like, okay, well, why are you squabbling over $5,000 when you think it's going to go to $500,000? And do you want to risk missing the trade? So what I like to do, and what I do is, once it gets in the teens, right, and you're getting, within maybe 10,000 of the low, I take a chunk of money, right, and I say, okay, how much am I really willing to invest of my net worth in Bitcoin? And let's just say 100K. And so I'll divide that 100K up into $20,000 increments. And then what I'll do is, at my first buy, it'll just be a very standard robotic 20,000 at, let's say, 18,000 or 16,000. And then what I'll do is, every $2,000 or $3,000, I'll just have automatic limit orders set where I'm going to buy a little bit more, another 20,000, another 20,000. And by doing that, even if it doesn't get to my lowest target where I wanted to buy everything, at least my dollar cost average, especially on something I think can go to 100 or 500,000, it's so low at that point. You just have to have some involvement in it, because you don't want to miss the next boat, the next bull market.
And can you expand on what brings you to those extremely high prices for Bitcoin? And maybe they wouldn't be extremely high prices. Maybe that's more fair value. But what gets you those price points of 100,000, 500,000, or $1 million?
For me, it's really understanding that as much as the Fed is playing the hard game now and won't be able to print money in a recession, if we get to a bad enough scenario like a depression, they're going to stimulate. They're going to go back to what they know best, because they're going to see the pain. They're going to feel the political pressure to print money again. And so inevitably, and this is, you can go back in history to the Roman Empire or to other things, this is how they kind of kept their economies on afloat during bad periods. But eventually, it's the undoing of the empires. And so if you're looking at something like a Bitcoin, which you have eventually, you have to assume regulation comes eventually, bigger money starts getting involved more and more. Number one, you just get like 1% of pension funds to put that money in Bitcoin, and right there it's 100,000, if not more. But you start getting some of the bigger money involved with proper regulation and protections, and it's so easy to see it at even $500,000 at some point. Now, we're not talking near term here. You got to give it like 10, 15 years, but at some point it makes a lot of sense as kind of the digital gold. And with a run of only 21 million possible, if it can get taken on as a digital gold, $500,000 on Bitcoin is not outlandish.
All right. Well, Gareth, we really appreciate your time and insights today. Before we let you go, where can our viewers find you online? And did you want to share with the viewers kind of what investors and traders should be looking at right now?
So I think the big thing here is to look for value that has been discounted. So, Meta, there's no guarantee Zuckerberg comes through, but we have to remember that he did buy Instagram and everyone bashed him for that. And that was a genius of a deal. He bought WhatsApp, same thing. Everyone said, oh, he overpaid. And so he has a track record that you have to give him a little bit of space here. And at these discounted levels, I think that makes a lot of sense. I think gold, we talked about gold. I think other stocks that are getting pounded that are quality names like a Google at certain levels, those start to make sense to kind of tuck away. Where to find me? Twitter's always the best place, at Gareth Soloway on Twitter, where I post lots of updates there. And then if you're more interested in specific alerts, trading alerts, investing alerts, inthemoneystocks.com for stocks, verifiedinvestingcrypto.com for crypto. And then I did launch a educational series with all the knowledge I have. It's a 20-hour educational series. And again, you can find that at verifiedinvestingeducation.com.
Fantastic. We'll put the links to those all in the video description. Thank you once again, Gareth, for joining us today, and God bless.
Thank you. You too, buddy.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.